Hi, thanks for joining me again. I had a request a couple of weeks ago from Fee Newen, who asked whether I could show how to mark the chart for support and resistance. When I'm marking a chart, I like to highlight the price action. I want the price action to come alive and allow the chart to tell the story that it's projecting from the price action. When Wyckoff talked about support and resistance, he thought of the lines not as horizontal lines, but as wiggly lines that ran across the top of support and resistance zones. And then when a breakout bar came in, it broke out above what he thought of as the support or resistance line. And then a new line began and a breakout bar took over and a new line began until a breakout bar. And same with on the downside. He thought of the price action moving just below all the lows of the bars until there was a breakdown bar. This is the way he thought of support and resistance, with a wiggly line following pretty much the highs of the range. Whereas when I draw a chart, I'm generally thinking of the levels as horizontal levels. And I will have some oblique lines, some angled lines, but generally I think of support and resistance as horizontal levels of previous support and resistance. When you're looking at a chart, you should probably think of the price action as moving in waves. This is my wave chart that I post each night. If I make the wave a little bit bigger, think of the price action as moving in waves. Here you've got a big down wave. Here's the opposing up wave, down wave, a little up wave, and so on. If you think of the price action in waves, then you can more easily mark the chart as to the support and resistance lines, because you're marking roughly the highs of the range and the lows of the range. This is the most basic way of marking a chart. And you can see here on this wave here in particular, the expectation when price moves up and you mark the high, after it's pulled back, when it tests that level, if it exactly tests the level like it did here, that's perfectly neutral. If price moves further above that line, in this case, it's pushed through resistance before it's come back, then it's showing you that resistance was not particularly strong there. And in the same way, if price can only pull back a proportion of the way and then heads lower again, particularly if it moves below the previous low, then the gap between where it reached and this previous resistance line is showing you weakness in the market. It doesn't necessarily mean it's bearish, but it's a measurement of weakness. This market was too weak to move up to touch this line and test the resistance. Let's look at that in a bit more detail. When you mark a chart, you shouldn't think of the line as just a single thin level of support or resistance. You should really think of it as a zone of support or resistance. In this case, prices moved up and then it's pulled back, and that's left this level here as resistance above. Now, the resistance level is at its strongest right where you mark the line, but that resistance fades out as it moves lower and fades out as it moves higher. It's like a zone of support or resistance, in this case resistance. And this level will fade as time goes on. There's no hard and fast rule for how long it takes for the support or resistance to fade. It's partially to do with how much volume is on the bar. A really, really high volume bar will project more support or resistance than a lower volume bar, and a really below average low volume bar won't have much at all, and the zone of support and resistance will fade very quickly. But also, as time goes on, if a level is respected over and over again, it kind of reinforces the support or resistance at that level, and as the level is reinforced, the zone of support and resistance extends into the future further. Generally, over time, support and resistance levels reduce in their strength. It's not a hard and fast rule how quickly it fades, but it does fade over time. So in this case, price has moved up to the level. We've marked our line at the highs of the range. Price has pulled back, and now it's moved up to the level where resistance begins, tested for supply, and you can see any push up and through is going to require challenging this level here. It's going to be tough as price moves up towards the level, and it's going to be easier as price moves out and through. And that's why you'll often see price come back and test, but it won't test exactly back to the line 100%. It'll test close to the line or in this zone. If price comes all the way back, it's neutral. If price doesn't come all the way back and then it takes off, it's generally stronger. And if price comes all the way back and deeper, then it's generally weaker. And vice versa when price is moving in the opposite direction. And if I flip the chart upside down, you can see the inverse is also correct. Now we've got the chart showing support instead of resistance. Price has moved down, formed support. It's bounced back up. It's come back down to the support line. Remembering support is at this level at its strongest. It starts to come in as the faded line emerges. Then if price broke below this level, there would still be an element of support below it, but it would fade out as price moves lower. And if it was able to break far enough below, it would break free of the support that was being found at this level. And that's why you find that support becomes resistance as price moves back up after breaking below an important support line like this. There would have been people buying in here and they're then holding. Price breaks below the level, and then they're concerned price is going to continue lower and leave them in a losing position. So if price comes back to this level after clearly breaking below it, the people who bought in here may choose to sell and get out for break even, and that forms resistance back at this level. Support comes in, but it's a zone of support. It increases as price moves down towards it, and it continues as price moves past the midpoint, but at some point it will fade out completely. The point being that when we look at support and resistance lines, we should really think of them as zones of support and resistance, not necessarily single thin lines of support and resistance. Now from there we'll look at actually marking a chart. If these were the waves on a chart with no price bars whatsoever, and we looked at how we would mark it, and we'll mark the highs of each range. Price moves up, then it comes back. Whenever price makes a push higher, some supply will be drawn out, and in response, price moves back to consolidate. This period of consolidation, the depth and the duration of the period of consolidation is a good measurement you can use as to the strength or weakness of the underlying sentiment in the market. So price pulls back and consolidates, absorbs any supply that's drawn out from the push higher, and then moves higher in response. Now, once again, price has gained considerably, so it will move back and consolidate, absorb any supply that's drawn out. If the market doesn't come back and test right to this line, it's generally a sign of strength. Doesn't mean the market is completely bullish. It's a sign of strength. And the depth and duration of this period of consolidation can be used as a measurement of the underlying market sentiment. Prices moved from here to here. Here was the move, and you can see that prices only pulled back to here. Perhaps it's a third of the way back down from the lows of this range to the highs. When you're using this guideline as a measurement to the underlying sentiment in the market, the higher in the overall range the market is able to consolidate, the stronger the market. If this pullback here came right back down closer to the lows of the market would be nowhere near as strong overall as if there's only a tiny little pullback in response. So you can use the depth and the duration of the pullback in response to a push higher as a guide to the underlying sentiment in the market. And the same goes for when price is moving lower and you're looking for a guide to the weakness in the market. And we'll see that as we move along. So we'll just tidy that up a little bit. So we would then mark the highs of the range again. You can see in this case, prices moved back almost exactly to the level. So it was much more positive here, and it's pretty much neutral here. We mark the highs again of the range. Price moves higher in response. Now, notice here, you generally see each push higher with a shortening of the thrust. We can't see the length of this push higher. We can see the length of this push higher, and you can see that the next one is nowhere near as high. Here was this one. Here was this one. And the push higher is only half as strong, but it's increased in this case. So when you see price accelerate higher, it can be quite positive, but it can also be a point where the market begins to sell off to some extent. Price has been pushed high with the intention of generating extra demand to sell into. And that's what I've tried to highlight here. Price has moved higher. The pullback has come just like normal, but there's no response higher. In fact, Wyckoff would call that an upthrust of this high. And price is then broken below the previous low. When you're marking the chart, you really want to be marking up bars on up waves and down bars on down waves. We'll look at that as we go further. So we've marked this low and price is broken down below it. At some point, price will move back up and it will generally test this level for strength. You can see in this case, price has not reached this level. So that's an indication this market is a little weak. It's a sign of weakness. We mark the next low. See price is broken down. This is the breakdown line. We call these the breakout lines. And these the breakdown lines. Price has broken down. Mark the next low as price pivots. You see this time price has moved well above the breakdown line. For the market to be allowed to push right through that previous breakdown line shows that the strength of the breakdown is not particularly strong. Price pulls back as it would normally. And now you've had a test of this low, this breakdown line, and a rejection. Price has not gone any lower. This is a spring of this low. Here you had an upthrust of this high. Here you have a spring of this low. This is a rejection to move lower. This is a rejection to move higher. Price moves up in response. It breaks out above the previous high. There's only a short period of consolidation and absorption, and price has not come all the way back to test the previous breakout line. It's a sign of strength, and market pushes higher in response. So you can see, just quickly, you mark the highs as price moves higher. Then you mark the lows as price moves lower. And you let the price action tell you what's happening. Price is broken out above the breakout line. Price is broken out above the breakout line. Price is broken out above the breakout line. Price has failed at the breakout line, and it's broken down below the previous low. And then price is broken down again below the breakdown line. Price has rejected moving lower here. It's failed to move lower than the previous breakdown line, and it's pushed higher in response. It's broken out above the previous high, which is forming the breakout line. Price breaks out again and pushes higher. And here you have the final push in this chart, where price has consolidated. The consolidation was very short, so the duration was short, and the depth was very shallow, and price accelerates higher in response. Let's look at some real charts now. This is the US dollar index chart. You generally mark the highs of up bars as price is moving higher, and the lows of down bars as the price is moving lower. Now, there's always things to be aware of. Generally, I'll mark the higher volume bars. You want the chart to tell the story. So this is a futures chart, and you can see here, these are contract rollover, and volume is always very high. So the bars they correspond with are not necessarily reflecting the amount of volume that's showing on the chart. You can see here, really high volume, but quite narrow spread. It's not reflecting the amount of volume in the market. So you need to really ignore these volumes. You can compare them to each other to some extent, but really you're best off ignoring them. In this case, I would mark that bar there. It's not the highest volume. This has got higher volume, but you can't mark that bar to mark the next high. So price has moved up. This is effectively a little mini breakout bar. Price has moved up to the high of the range again. It's pulled back and it's tested this level. It's moved up to this level again, tested a second time, and then you've got a little mini breakout bar again. Now, I'll see this as a little period of absorption, like bullish absorption. Price pushes up. I'd probably mark the high of that bar. It's got higher volume, and this bar has popped out the top, but price has pushed back underneath. So this was really a fake out, not a breakout. And this continues really right across like this. Price is pushed up to the level. A low volume push higher that hasn't really broken out. I come back and test. Now you've got a secondary push up, so you could sort of mark it like that. Now this bar here, I wouldn't mark the high of that bar. I would mark the close, because I don't like marking bars with high tails. It just doesn't sit right with me. So I would mark this bar's high, or I would mark that bar's close. It's a personal preference for me. The volume was higher on this bar. It's either or. And you can see that it tells a story. price has pulled back, it's consolidated, price has moved up, and it's broken out above the line, and it's respecting that line at least for now. The next chart is gold. This is gold futures. Now, here's an important level. It's high volume. I wouldn't mark this bar. First of all, I'm marking down bars as price is moving lower, not up bars. This bar is closed as an up bar. And I'd much prefer to mark high volume bars, not low volume bars. So I wouldn't mark this bar for that reason. And then if I'm marking it for the first time, I'm seeing the chart like this, I can see that price has respected this level. So this is the right level. If I mark the lows of the range, it hasn't really respected that level very well. Much more correct here. And I would mark that level there. Now I can see high volume here, spread narrowed. So support came in here. You had a little bit of testing for supply. Below this bar's low, and it's closed as an up bar. I'm really wanting to mark the lows of down bars in a downtrend, and price is definitely trending down here. So I would mark that level at 1700. It was respected here. Price is held on. Now price is threatening to break down. There's still 2 days trading for this bar here, so it's a weekly chart. So we can't really analyse this bar properly yet. It's only half formed. But remembering you want to mark the lows of down bars when price is trending lower, and the highs of up bars when price is trending higher. And you can see over here, price has moved lower here, a little shelf has formed, and the bars have respected the lows of this bar. Here's the volume here. Now here's a little bit of a trick. You've got this bar or this bar. Which one are you going to mark? You could mark it there, or you could mark it here. Now, for me, here's the high volume on this bar, and this bar has much lower volume on that bar with a little bit of a tail underneath it. I don't really like the tail too much. I would mark this level for sure. You see the close respected that level, the close respected that level, price dipped below but closed back above. The low respected the level, the low respected the level, the close respected the level. This is the right level. This is, you can see the price action is telling you subsequently which is the right level. And in response, price moves higher. So you can see price respected all those levels all the way through. It told you where the correct level was. The high volume told you where the correct level was. The long tail led you astray. The low volume led you astray. So I would mark that level there. On the downside here, I would probably mark this level. You can see there's weakness. The market did not come up and test this level correctly. So there's a sign of weakness in the market. Price moves down. I mark the lows of this bar with the higher volume, not the lows of the up bar in a downtrend on low volume. And once again down here, I mark the lows of the high volume down bar, not the lows of the lower volume up bar. Okay. This is the XJO, the S&P ASX 200. Now, on this chart, generally when you get a really widespread down bar, you mark its lows. But we had a subsequent down bar. It wasn't as widespread, but the volume was higher. So there's a little bit of a dilemma here. If you marked both, you wouldn't go too far astray. But let's just take them off for a sec. You can see that there's definitely support came in here. Spread narrowed. Volume was really high. The next bar respected the previous bar's low, and then price pushed up in response. This was buying support come in, and you can see price then consolidated for 2 bars and then pushed higher. So I would mark a little mini level here because that's how I'm trying to highlight the price action, and prices moved up, respected this level, tested for supply, absorbed supply, and then pushed higher. They pushed higher over 3 days. And you can see price, if you mark the highs of this range, price did respect this level. We'll come back to that. If you mark the lows of that range, you catch this bar's low. And then you can see a little shelf formed in here, which caught this low here. This bar respected it. This bar pushed back above it after dipping below, and this bar closed right at it. So there was a couple of little minor levels in here. You had another one there. It depends how intricate you want to be. At some point, you can put so many lines on your chart, you lose the picture. So you just need to highlight the chart and show the lines that best highlight the story the chart's trying to tell you. So if I was to start this again, I would mark that little bar there, and I would mark those 2 levels there. This is showing the consolidation that took place here. We know price pushed up and pulled back, and it's tested this level for strength. We'll just take that for granted. Price is pushed up, and then I don't want to mark the long tail here, so I mark the close, and you can see price has respected that better, and it more highlights the correct breakout bar. This was the breakout bar. And you can also see that price traded in a little range here, which was respected from this low. You had a period of absorption going on here. This is like bullish absorption, and that was as price moved past this level. When price moves past a previous support or resistance level, it will either burst through with a breakout or breakdown bar, or it will grind through. In this case, price has ground through. It's absorbed its way through and past this level, rather than blasting past it with a single breakout bar. In response, after prices cleared this level, you can see price accelerated higher and then moved into another period of absorption. Prices just grinding higher here. There was perhaps a little level just there where price broke out above the highs of the range, tested for supply, and then prices moved higher again there. You mark the highs of the range when it's formed. You can see that it's been respected and then respected here. Prices pulled back. You mark the lows of the range here. Prices come back and respected that level. The closes closed right back on it. Prices tried to bounce back off this level, tested for supply, but then failed. And here's the breakdown bar. Now you could mark the lows of this bar, or you could mark the lows of this bar. You just have to wait and see how price shows you how it's going to respond. I've chosen to mark the lows of that bar and think of these 2 bars as 1 bar combined. If you mark the lows of that bar, it wouldn't really matter. It's a personal preference in a way. I mark this bar's low and thought of these 2 bars as 1 big bar. Now price moved lower here and appeared to break down below this breakdown line, but it was dangling in the middle of nowhere. Normally you'd see price come back to a logical level. It probably came back to the highs of that bar. I don't really like that bar. I don't like the longer tail on it. Perhaps that's the best explanation for it. But for me, price was dangling a little bit in no man's land. I much preferred this level here. And perhaps I was proven right. I remember saying it at the time, because immediately price reversed, closed back above the highs of the down bar, which was showing you a sign of strength, and price responded higher. This level was always going to be an issue, with the supply in the congestion probably being locked up there. I think price was going to give it a good crack, to be honest, and stay in this level, but overseas markets broke down and we broke down in response along with it. And price is trying to consolidate now at this level. So we'll just see how that plays out over the next little bit. But just quickly marking that chart again, so you can see you would mark these extremities for sure, but at some point you have too many lines on your chart. What you want to do is highlight the price action so it can tell the story of what is going on in the chart. If you can achieve that, then you can read the price action and form a narrative that will help you understand what's going on in the market. And that's the most important thing, being able to see and understand what's going on in the market. It's a pretty big subject, marking a chart and all the support and resistance guidelines that I use. Perhaps I'll do another video at some point with some more detail. I'll keep an eye out for some important principles when they emerge, and as I see them, I'll keep a note of those charts so I've got some good subject matter to work with. Anyway, that's my lot for now. Hopefully that was worthwhile. It might have been a little bit long in the end. Thanks for joining me anyway. Thank you. See ya.